Welcome to Portfolio Institutional's latest webinar interview. Today we're covering the very timely issue of DC-focused investment with Ruffer. I have with me James Fouracre, Ruffer's DC expert, to explore this in detail. Hello, James.
Hi there, and thanks for having me.
No problem. It's a fascinating subject, and hopefully we'll have a great discussion. I'd like to, before we dig into the important issue of financial markets and DC pension portfolios, could we, James, first explore Ruffer as an investment group? What type of organisation is Ruffer?
Sure. So Ruffer was set up in 1994 by Jonathan Ruffer with an investment approach focused on absolute return and capital preservation. As it happens, over the cycle we've been through since Ruffer was founded, there have been four major bear markets in that time frame. So .com, global financial crisis, COVID-19, and most latterly 2022. And we've managed to deliver positive returns in all four of those bear markets by avoiding the drawdowns. And that's the key focus. How do we avoid capital loss at times of crisis? We've now grown to 26 billion in assets under management, with offices in London, Edinburgh, Paris, and most recently in New York, with a balanced mix of clients across institutional, wholesale, and private wealth.
Oh, fantastic. That's a great insight. Thank you. And you're still a private partner. That's correct. What are the benefits of that as a structure?
Yeah, I mean, we believe that the partnership structure helps align Ruffer to the aims of our clients in the sense that it allows for a long-term focus. As an LLP, we're not at the short-term behest of shareholder demand, whether that be from a standpoint of product iterations or short-term shareholder demand, which, if I may, sort of leads on to a second point of differentiation, which is, relative to the wider asset management industry. We see real value in our proposition as a single strategy asset manager. The outcome of that is that we have over 300 colleagues with the single and sole objective of delivering a successful outcome for our clients in that one global macro, unconstrained and unbenchmarked multi-asset strategy.
Okay, that's fantastic. You also make the point of having capital preservation at the core of your strategy. How do you therefore articulate to clients that you may not fully participate in the rise in asset prices during bull markets, as that would appear to me a tough sell?
Sure. So, I mean, directly, we over the firm's history, we've delivered an 8.5% annualized return for our clients over a period of 28 years. Those returns have been a result of participating as fully as we think appropriate in bull markets, whilst also maintaining a concentrated focus on capital preservation during bear markets. So as a relative measure, what that then adds up to, given the cash rate has been about 3% over our history, is that cash plus 5 is a reasonable output for the portfolio. If you are seeing our returns dropping off relative to the market, that is typically an indicator that we are seeing a less attractive opportunities in the market and less asymmetries.
Okay, that's fantastic. Thank you. Turning to the investment process, can you give me a sense of the Ruffer investment philosophy?
Sure. So we start from very much a blank sheet of paper, unbenchmarked, as previously said, and we put in place assets that we believe will protect clients' capital against the market environment that we see forthcoming. What is the next market regime going to look like? What are the right assets to hold amidst that regime? And then additional thinking about, what if we're wrong about that regime? What if we're wrong about the timing of it? What assets will we need to carry those protective assets to the time when they're needed? And I think, that is the core of what makes us different to the rest of the industry. Most asset managers are focused on return optimization first and foremost. What are the best opportunities in the market, compile them together, and risk management is often an afterthought. And so rather than a focus on return maximization, our focus is on risk minimization. Risk management is endogenous to the construction of the rougher portfolio at any given moment in time. So the prevailing thoughts are, what are we concerned about most? We put in place the assets that we think will be required should those risks come to pass, and then let the return take care of itself rather than the other way around. So an inversion of the telescope, if you will.
Oh, brilliant. Yeah, thank you very much. That's excellent. Turning to the markets and the very timely issue of financial markets and DC pension portfolios, would you say the traditional 60-40 portfolio is now an outdated and redundant investment approach in DC?
The 60-40 portfolio has served investors well for the past 50 years. It's been the allocation of choice for traditional balanced portfolios, 60% in equities for the good times, 40% in bonds for the bad and for the yields. However, the traditional balanced portfolio is based on a certainty, and that certainty that bonds and equities are offsetting assets. And this approach has emerged from a world of falling interest rates, low volatility, and low inflation. And several disinflationary forces have prevailed over that period of the last half a century. Aging demographics, the growth of IT, the re-emergence of China, and globalization, amongst many other things. And the important reflection is all of those are most certainly in decline. Many of those are now in reverse.
Okay, thank you. So is the very premise that bonds and equities are negatively correlated now threatened by high inflation, as that does seem to be the case?
Yeah, data evidence that when CPI is above 2.5%, bonds do not effectively offset equities. Thus, the relationship turns to one of positive correlation. The return of inflation changes everything and calls into question the certainty upon which the entire investment system is based. Inflation, as we witnessed in 2022, very recently, has and could continue to spell disaster for balanced portfolios. Bonds are the bedrock of the balanced portfolio. The case for owning them is twofold, as an offset to falling equities, and for the income or the yield. But in an inflationary environment, neither of those stand to reason. The implicit assumption of the balanced portfolio, of course, is that stocks and bonds are negatively correlated, that they move in opposite directions. And this assumption is wholly reliant on the economic policy of recent decades. When stocks go down, central banks cut interest rates in response, in turn pushing yields down and bond prices up, therefore, or thereby balancing your portfolio.
Excellent, yeah. Therefore, how should modern DC default funds be constructed if the equity bond model is redundant?
Yeah, clearly much thought is given to this at this moment in time. I think few portfolios have changed to reflect this new environment as we stand. Conventional bonds remain the bedrock of supposedly balanced portfolios. A number of investors seem to be sticking to the status quo, trusting a portfolio structure which has seen them through thick and thin, as I say, over the course of the last half a century. But as previously stated, the return of inflation poses a new threat. The key to survival, we think, will lie in diversifying beyond the traditional balanced portfolio. In a market regime change in which equities and bonds fall together, investors will need an asset with low correlation to these markets and negative correlation at points of stress. Traditional alternatives are often pseudo equities. So a genuine diversifier is required in the current regime within DC portfolios. To our mind, a benefit of being global, multi-asset, benchmarked investors is that you can go anywhere and invest in anything. And this flexibility is increasingly essential in a world where safe havens are so expensive that they've become dangerous.
Excellent. That's fantastic. Thank you. So looking ahead and focusing on DC investment thinking, what do you interpret to be at the top of trustee consultant and CIO agendas in 2023, what's remaining of it, and heading into 2024?
Yeah, I think from our engagements and discussions across that spectrum of DC stakeholders that you outline, certainly a predominant focus is now pre-retirement and decumulation. To summarize those discussions, coupled with our observations, the investment challenge DC portfolios face are dual-faceted. Firstly, the material impact of the evolution of DC membership. Casting our minds back to 2012, as auto-enrollment began, there were two structural forces at play. One, a young demographic, and secondly, retirees' DB scheme was their main provision. And then you then reflect on the environment in 23, those two structural forces have largely dissipated. Members are now migrating into the pre-retirement phase. Indeed, we're now seeing this baby boomers bulge with close to 1 million members reaching a minimum normal retirement age each year. And the second element to the investment challenge is the new investment regime that we've touched upon, that we find ourselves in. There's been a reliance on the same thinking with respect to DC portfolio construction for the last 3 to 4 decades. A combination of pension freedoms and quantitative easing has ultimately left the market vulnerable to flawed thinking on risk. So whether that be the use of bonds as a protective anchor in portfolios, a view taken on the sort of upwards trend in asset class correlation, or indeed higher inflation volatility leading to higher portfolio volatility, in turn higher retirement outcome volatility. All these things matter when constructing DC portfolios, particularly in pre-retirement.
Fantastic, thank you. So what does the solution to these challenges you outline look like?
I think the sort of the best starting point to try and answer that question is to sort of consider what members' needs are at that point in the life cycle. DCIAA research suggests that this is twofold. In the first instance, that investment losses are minimized and the destructive consequences of sequencing risks are largely removed. And in the second, that with an appreciation, particularly for the ever-increasing life expectancies, coupled with the FCA research reporting high single-digit average drawdowns amongst membership, that the investment vehicle needs a growth engine too.
Oh, fantastic. That's fantastic. Well, that's an impressive run through of the issues. Thank you very much for your time today, James. And thank you very much for watching. Thank you. Goodbye.
Thank you, Andrew.